Welcome back to Success with Steven. My name is Steven Smith. On this channel, we talk about everything financial literacy. And today, we're going to be talking about the Navy Federal Home Loan and how you can actually get multiple loans with Navy Federal with zero money down and with very, very low interest rates depending on your credit worthiness. I want to talk really quick about home loan pre-approvals. Then we're going to get into some facts. And then we'll be discussing each of these home loans. It's going to be 5 different home loans. And then we're going to be trying to find the differences and the advantages, maybe disadvantages of each one. That way you have a full understanding of each of these home loans. This video may be long. And if you want to skip to a certain part of the video, then I suggest using the timestamps in the description if you just want to know more information about one particular loan. We all know in the economic climate that we're currently in, buying a house, it isn't easy. It's actually fairly difficult. Not only do you have to find the right house, you also have to find it in the right price range, but you have to make sure that your finances are in order so you can qualify for a mortgage loan. Now, if you wait to apply for a mortgage loan until after you found the house that you actually want, time can be a factor. With housing stock generally being low, there may be other people who want to buy the exact same home that you might want. And if there's a hiccup in your finances, then it could cause you to lose the chance to buy the home that you really want. So getting pre-approved for a mortgage can make the home buying process a lot smoother. So I just implore you, as a first-time home buyer, you should get pre-approved before you do anything else. And you'll probably hear this from real estate agents. You'll probably hear this from a lot of people. You want to get that pre-approval letter. This is one of the most important steps when buying a home, and you need to determine exactly what you can afford to actually spend. Getting pre-approved gives you an idea of how much you can spend and lets you tailor your search for houses to your range that you are approved for. But if you don't get a pre-approval, you're just simply guessing at what your budget might actually be, and you may not get what you think. So, for example, if you think that you can afford a $800,000 home with a $100,000 down payment, and it's just a, fairly frivolous example, but if you haven't gone through that pre-approval process, you may end up surprised that you only qualify for $500,000. You may not qualify for the $800,000. And if you have already put in an offer on that home, you can afford it. It's a waste of time, not just for you. It's a waste of time for your agent, the seller. And getting pre-approved forces you to be realistic in your search for a home and finding one that's in the correct price range. Home sellers often want to streamline this process. They want to make it as easy as possible. They don't want to gamble on a deal that might fall through. So if you get pre-approved, it makes it clear to the seller that you're serious about buying, and it makes it clear to your real estate agent that you're serious about buying. And if you don't have that pre-approval, another potential buyer who does may actually get the home just because the seller will look at them as being serious while you still have to go get pre-approved. So this is just, my one thing I want to stress in the beginning. I know some people who are real estate agents. That is one of the things that they make it a great point to tell anyone that's buying a home for the first time. Get the pre-approval so that we know exactly what we're looking for, what we can afford, and we can make this process a lot smoother. All right. Now, let's get into a couple of FAQs about the Navy Federal Home Loan and just some general information about home loans you may just want to know for the future. So first thing, Navy Federal does not offer FHA loans. There are other comparable products that we will talk about, but just want to get that out the way. Navy Federal, as far as what I know currently, if this changes, let me know in the comments, because again, as videos age, as new information comes to light, things change. But as far as I know right now, they do not offer any homes that are more than 1 to 2 unit residences. They'll only finance 1 to 2 unit residences. They'll not do 3, 4 larger. Okay, so just be aware of that. The VA loan and the conventional loan, they will have the lowest interest rates. Now, the reason why I want to make that a point right now is because if you were just looking at the home with the lowest interest rate, it doesn't necessarily mean that's the best loan for you, or it's not. For example, a conventional loan, if you don't want to have any PMI, private mortgage insurance, you'd put down 20% on that home. Some people may not have 20%. The more you put down, the lower your mortgage is. You can make more equity on that home, especially if it's a rental property, if you do it that way. Now, for a first-time home buyer who wants to keep their home for just them, then maybe it might make more sense for you to do one of the no money down options. There is no which one is better. It just depends on your situation. So again, there's a situation where it's better for you to put down more money. There's a situation where it's better for you to put down less money. There's a situation for every scenario and where everyone is at currently. So I just want to get that out the way. The VA loan, conventional, they will have the lower interest rates, and they're going to have lower interest rates than some of the 100% no money down. But they also have, with Navy Federal, no money down options on these same loans. Okay. And again, everything just varies by your situation. Now, I want to talk about credit worthiness for 1 second. For credit worthiness, when it comes to home loans, it can actually vary. Conventional loans require credit scores usually in the good range or the fair range, in like 620 at least. This is not always a requirement. Okay. The government-backed mortgage loans, like for example, FHA loans, they don't have the same type of qualification requirements as a conventional loan. So you can have a lower score, like a 580. Usually 580 is the minimum, but they can actually go as low as 500. So the thing is, when it comes to credit worthiness, your credit score can really range when it comes to getting a mortgage loan. So there is no like one thing I could just tell you that's going to be true. It depends on the lender. What I can say is the higher the risk, the higher the interest. And I'm going to show you on a calculator differences in interest. So my thing is, it's not just about getting approved for a home. It's about doing something that's actually feasible. Yes, you can get approved for a home with a 580 credit score, but the difference you might pay in interest, if it's 2%, that may be the difference of a couple $100,000 over a 30-year term. It does matter. So I would suggest always getting the lowest interest rate possible, because you want to pay as little money back to your bank or your credit union as possible for your best interest, so you can keep more money in your pocket. Okay. So I just want to make that a point. I also want to talk about seller contribution, because some of these loans, they're going to have seller contribution with a different amount. And depending on that may help you if you're a first time home buyer or you don't have larger amounts to put down. So seller contribution. A seller contribution is when the seller of property chips in to pay a portion of the closing cost. I have an entire video on FHA loans where I literally go and show you an example of the loan, what closing costs look like, what you can expect to pay, because it's going to be different than what you think. It's not just going to be the down payment. There's additional fees and costs that you want to look at. That video is like an hour and almost 30 minutes long. I spend a lot of time on it. I suggest you refer to that video. It goes way in depth about the home buying process, especially if you're a first time home buyer. And that video is applicable to even conventional loans, and it's applicable to even this. So if you want more information about that, I suggest you watch that video. When it comes to closing costs, seller contribution, the seller can chip in, and it's an alternative to lowering the actual purchase price. So I'm sure you're thinking, why would the person selling a home want to do this? Well, for sellers, they can make their property more attractive to potential buyers by reducing the money the buyer needs to bring to the closing cost table. This may lead to a faster, more streamlined sale. And there are different loans that allow you to get more from the seller depending on the loan. So those may become more attractive. Those will have higher interest rates. So it's a balance, guys. So we're going to get into the situation where seller contribution can help you with the closing cost and with the final price of the home. But I just wanted to mention all of this now. That way I don't have to double back to it in the as we're talking about each loan. Okay. Hopefully this makes sense. If you need to refer back to it, then you can rewind back to this point. I'll have it time stamped where we talked about, seller contribution and some of these other facts. And again, if things change, then please let me know. if you look at any of these credit requirements for loans, pretty much it's the same. Again, for conventional, 620, lower 600s can usually be the range. It depends on the lender. You can have credit scores for FHA loans as low as the low 500s. Usually it's 580. That's kind of a standard. It depends on the lender. But, just be aware that these are things that you're going to have in order when you think about buying a home. You're going to have these things in mind. Okay. Now, the first loan that we're going to be talking about is the VA loan. And the VA loan is going to be for veterans. So if you're an eligible active duty military member, a veteran, or you're a surviving spouse, you can use a VA loan. It's guaranteed by the U.S. Department of Veteran Affairs to buy a new property or refinance an existing mortgage. VA loans offer many benefits such as no down payment or mortgage insurance. So you don't need to have PMI. PMI is private mortgage insurance. I'll talk about that a little bit more as we continue. But like I said, I have another video that talks about that. And it talks about the other type of insurance for FHA loans. You don't have to pay that with a VA loan, which is definitely one of the things that makes it the most attractive. Qualifications are lower. You also get lower interest rates. However, there are also some drawbacks such as required funding fees, property restrictions, and potentially less equity to start. So we want to talk about the pros. We want to talk about the cons. So here's the benefits of a VA loan. No down payment required. That's one of the things that makes this loan very, very attractive. VA loans allow eligible borrowers to become a homeowner without contributing a penny up front. You don't have to pay anything up front. 30% of aspiring American homeowners believe they'll need 5 or more years to save up just for the down payment. And 10% think they'll need to dedicate 10 years or more in order to get their down payment for their home, just to make it affordable. They think that they need that. No mortgage insurance. There are mortgages that require only a small down payment, but it'll cost you. For example, FHA loans charge mortgage insurances both an upfront premium and an annual premium throughout the loan term. That's one of the downsides of an FHA loan. So you'll also pay private mortgage insurance, PMI, on a conventional loan, and there's a separate one that you have, again, for FHA loans. Now, lower interest rates. Lenders tend to charge a lower interest rate for VA loans than they'll do for a conventional loan, which means that you can save a lot of money on the interest in the long run. That's the biggest advantage to me, especially over a 30-year loan. VA home loans closing costs might be less than those of other loans as well, since the VA limits the origination fee a lender can charge to no more than 1% of the mortgage. That is another advantage. Also, easier qualifications. The VA doesn't set a credit score minimum for borrowers. Again, there's no minimum. Usually some banks they want 580, but technically there is no minimum. In addition, VA loans may have more lenient DTI, that's debt to income ratio. Once again, I'm sorry to have to keep saying it, but I have a video where I go over all of this stuff, like really in depth. So please, I'm going to link it somewhere at some point. Please click that if you really want more information about these insurances, debt to income ratio, and how this all works. They allow for a maximum DTI as high as 41% compared to conventional loans, which typically have a DTI limit of 36% unless you have compensating factors. So again, they allow for debt to income ratio to be a little bit higher. I honestly think that you should be more privy to your debt to income, because there's a lot of factors that aren't considered. Don't take on more than what you can afford. It doesn't make sense. All right. You don't want to be home rich, but then cash poor. It doesn't make sense. All right. So, just be mindful of these things. They also have convenient refinancing options. A VA cash out refinance option allows qualified veterans to borrow up to 100% of their home's value in cash at closing, though some lenders may limit the amount to 90%. Either way, that's more than many refis, which allow limits of up to 80%. If you just want a straight loan swap, no cash, you can opt for an interest rate reduction refinance loan, or RRRL, if you want to look at that as an option. It doesn't require a home appraisal, unlike most refis. Plus, the funding fee on a VA RRRL is relatively small, just 0.5% of the loan amount. And VA loans are assumable, meaning that if you're selling the home, your buyer can take over the mortgage instead of obtaining one of their own, even if they are not a veteran. So someone else can still get this, even if they're not a veteran. So VA loan assumptions are especially beneficial when the interest rates are rising, which loan assumption requires extra steps. The lender must approve, and the seller has to keep their full VA loan entitlement, which impacts future home purchases. They can be an excellent perk for a buyer. So that's another advantage that you have. They also are more lenient when it comes to bankruptcies and foreclosures. That's a huge benefit. They offer more flexibility. So if you've encountered some financial challenges like bankruptcy or sold a home in a short sale, for example, the typical waiting period after a foreclosure is around 2 years. 2 years is not that long. It's especially if you did a short sale. And that's in comparison to that of like a 3-year waiting period with the FHA loan and up to 7 years with a conventional loan. That is a very long time. One other thing is the seller contribution of up to 4%. The seller is allowed to contribute up to 4% of the value of the home towards your qualifying closing costs, which could save you money. That is a huge advantage. All right. So there's a lot of advantages to the VA loan, but of course, to the contrary, let's talk about some of the disadvantages. So while the VA loan offers, as you know, we talked about so many benefits, there are a few drawbacks. Funding fee that's required. While you won't pay for mortgage insurance with the VA loan, you will pay a funding fee at closing costs, although this fee can be financed into your loan, increasing the total amount that you owe. If you're taking out for your first VA loan and putting down less than 5%, the funding fee is 2.15% of the loan amount. The fee increases, however, if you get another VA loan and also put down less than 5%. If you make a down payment of 5% or more, the funding fee is smaller. So that is up to you. But if you're putting no money down, then you will notice the funding fee will be higher. So not all borrowers are required to pay the funding fee. For example, if you receive compensation for service connected, like disabilities, or you're a veteran surviving spouse, for example, you may be exempt. So that is a situation where that may not be a problem. There are property restrictions. So VA loans limit the type of property that you can buy and how you can use it. You can only buy a primary residence with a VA loan. This is why I was talking about when you're looking for investment property, conventional loans might be better for you, and it will vary. A VA loan is when you're buying your home, a home for you. This is where it's most beneficial. So with all the advantages of a VA loan, you shouldn't be looking at this loan to use for investment property or to make money with. So again, that is going to be one of the drawbacks. So no investment or rental properties unless you intend to live in one of the units. And again, they only offer you the 1 to 2 unit residence. So at most, you can only add maybe one other family at most. So like a duplex or something like that. So manufactured homes are also subject to more scrutiny, including a structural engineering examination. The other drawback that I believe is that there is less equity to start. So the major upside of the VA loan is the ability to get the mortgage with no down payment. However, you lose some equity up front when you choose to do that. Now, those are the advantages. Those are the disadvantages. Hopefully it gave you a little more information on the VA loan and how maybe it'll assist you in your situation. Let's go a little bit further and let's take a look at the Navy Federal calculator. And I want to kind of show you what you're looking to actually pay for this particular loan. So currently right now we are on the Navy Federal website. I'm looking at the mortgage loans. We're looking at the VA loan. Now, at the time of recording this video, it's showing you that interest rates are as low as 4.875%, APR as low as 5.599%. Down payment can be 0 with terms from 10 to 30 years. Now let's scroll down and take a look at the calculator. So right now we're taking a look at the calculator for a VA loan. Now let's say you had a VA loan for 30 years. Let's do a 30-year VA loan. How much is the home you want to buy? Let's do $500,000. And let's say that you want to put $0 down on this home. So your monthly payment can be as low as $2,761.02, with the APR as low as 5.709%, with interest rates as low as 5.250%. And then I also want to show you, if you were to put down, let's say 20%, then your payment changes to $2,208.81. All right. Now, I'm sure you're wondering right now, why do I have an APR and I have an interest rate? Well, let's talk about that for 1 second. So interest rates, they refer to the annual cost of a loan to a borrower, and it's expressed as a percentage like we see here. Now, APR is the annual cost of a loan to a borrower, including fees like an interest rate. The APR is, of course, expressed as a percentage, just like this one. And unlike an interest rate, it includes other charges. In this case, it won't have mortgage insurance. Sometimes it does, but in this case, it won't. But sometimes it has the closing cost if it's built in, discount points, and loan origination fees that can also be worked in. So even though you're seeing this, the APR and the interest rate aren't going to be the same. So why the difference? The APR is intended to give you more information about what you're really paying. And the Federal Truth in Lending Act, it requires that every consumer loan agreement disclose the APR. So they have to show you both of these. Since all lenders must follow the same rules to ensure the accuracy of the APR, borrowers can use the APR as a good basis for comparing certain costs of loans. Remember though, your monthly payment is not based on APR. It's based on the interest rate that it's going to be on your promissory note. All right. So I just wanted to cover that because we're going to be looking at this a little bit more, but I just wanted to show you how much you're looking to pay, how much you're looking to actually save, and the difference between down payments. And don't forget, when it comes to closing cost, it can also be covered up to 4% by your seller's contribution. All right. Let's move on to the next type of home loan. The next home loan that we're going to be looking at is going to be the military choice loan. Now, with the military choice loan, it's going to be very, very similar to what we saw with the VA loan. Now, with the military home loan, this type of loan is tailored for veterans and active duty military members who have already utilized their VA home loan benefit. And similar to the VA loan, the military choice loan doesn't require any down payment and offers a fixed interest rate, with the seller being able to contribute up to 6% towards the closing cost. Think of this as a conventional loan with no money down. Like the previous one, there is no PMI. There is no private mortgage insurance that's required. You get to put down, of course, less than 20%. No refi rate drop. That's the other difference here. So there is an easy no refi rate drop. You have rate drop assurance. So buy your home now, and if rates drop later, you can lower your rate without refinancing for a one-time $250 fee. That is the plus when it comes to this military choice loan. You will not have to worry about refinancing. Your rate can be adjusted for a $250 fee. So if you've already used your VA loan, this is the next one that I would look at doing. Now, with the military choice loan, and you can correct me if I'm wrong, but I believe that with this one, you can use it for an investment property. I don't believe you have to be a primary resident. Now, again, I have to double check that, but I believe that that is the case. So you could even look at this maybe as a secondary option. But now that we know what the difference is between the military choice loan, biggest difference is the no refinance rate drop. You do not have to refinance your home in order to lower your rate. That's one of the biggest differences. The other difference is your seller contribution can be as high as 6% for this particular loan. All right. So let's look at the actual calculator so we can see the difference in what we're paying monthly for this particular loan. All right. Back on the Navy Federal website right now, we're taking a look at the military choice loan, and Interest rates are as low as 6.250%. APR rates are as low as 6.566% with a zero down payment. Term 16 to 30 year. Let's just scroll down here. Let's do the military choice loan. And we'll do the same example, $500,000. And let's say that you're going to do zero down for this loan. Now, as you can see, your previous mortgage was somewhere around $2,700. It's $3,078.59. Now, that's this is the reason why I made it. I'm making a point to do this because I just want you to see the difference of what you're paying when you put down money, when you don't put down money, and the difference 1.5% can make. The difference is almost $300 you're looking at paying a month, somewhere around there. Now let's look at if you actually put down 20%. All right, now if you were to put down 20%, remember our previous one was like $2,200. Now you're looking at $2,462. Now the good thing about this military choice loan, you can lower the interest rate without you having to actually refinance your loan and start over. So you can literally it could be 10 years from now, and you may be able to drop this APR to somewhere at 3%. Now, that's the awesome part about this loan. You could do that without refinancing. They'll just drop the rate. That's why even if you're paying an extra, like even if it was $200 or $300, interest rates most likely will come down. So if you refinance and if you can drop the rate without having to refinance, that could be a huge advantage. So just know that, if you're paying a little bit more, but being able to have that trump card up your sleeve, it might make this loan a great option for you. So highly consider that. The next loan on our list is going to be the conventional loan. The conventional loan is something that everyone's probably familiar with. Normally, people talk about the FHA and the conventional, but Navy Federal's conventional loan is pretty much the same as any other conventional loan. It's a fixed rate mortgage. It's a great option for home buyers who want a stable monthly mortgage for a long term. And the minimum that you have to put down on this one will be 5%. You have to put down at least 5%. Lots of loans require up to 20% down payment. Some of other loans only require 5% down, so you can buy the home sooner. So that does make this loan a little bit easier to obtain. You have the no refi rate drop on jumbo loans. So with the easy no refi rate drop, you have the option to drop the rates if the rates are lower on the home later. And you don't have to do that with refinancing. Just like the previous loan, you just pay a fee of $250. There's no PMI insurance required. That is a big advantage for a conventional loan with less than 20% down. And there are refinance options available. So if you already have a mortgage and want to refinance for a different interest rate or a shorter term, this option may also be a good fit for you. Again, all these things are situational. They depend on exactly what you're doing. And for this one, let's take a look at the calculator and see how much we're paying and what benefits that we could get from this particular loan. All right, so back on to Navy Federal. Our conventional fixed rate is 5%. So remember I said that the lowest interest rates that you're going to get is going to be from the VA loan and the conventional loan. And the APR can be as low as 5.191% at the time of recording. Down payment 5%. Terms 10 to 30 year. So we're now looking at the calculator for the conventional fixed rate, a 30-year loan term, $500,000 home, same that we've been doing. 5% would be $25,000. And now your monthly payment is as low as $2,734.37 with an APR as low as 5.763% with an interest rate as low as 5.625%. So as you're seeing, you're getting a home loan that is, or a mortgage that's very, very close to what you were getting with the VA loan with putting no money down. Now let's put down 20% and almost the same. It's a little bit higher. $2,302.63. APR as low as 5.763% with an interest rate as low as 5.625%. Here's the advantages with this loan. You got the refi option again, like the military choice. You could lower this rate if you want to. So that can happen in the future. That is a benefit. Another benefit is with this particular type of property, If you want to use it for investment purposes, you are able to do so. So that is the other option. It just depends on exactly what you're doing. So this may be something that you may want to consider, and there's no PMI that's required, even if you're only doing 5% down. That is the advantage of doing this with Navy Federal. So that is awesome. Definitely take a look at that. And again, every situation is different. It depends on what you're trying to accomplish with this particular property. All right, let's move on to the next one. All right, the next loan that we're going to be looking at will be the Home Buyer's Choice Loan. And this is a 100% no money down financing loan. So the other ones were optional. You had the option of putting money down, not putting money down. This one is a no money down loan. So it's 100% financing loan and no PMI with seller contribution up to 6%. Now this can be a good first time home buyer's loan. I would say that if we're talking about like in comparison to the FHA loan, this is a much better option. Normally on a conventional loan, you'll have to do the PMI, and on an FHA loan, you'll have the MIP. That's the other type of insurance for an FHA loan, and that's when you put down less than 20%. So this gives you the same advantages as an FHA loan. You also saving not having the MIP. So, I mean, that makes this one very amazing. You get fixed rates with consistent payments. You get the no insurance, no PMI, no MIP if it was a FHA. There is the no refi rate drop. So that is a big advantage. So if rates drop, you can get it lower. And there's also refinancing options. So this one you're probably looking at thinking, man, that's the best loan that's on this list. You know, that's how it would be perceived. But again, that's the reason why I like to look at the calculator, because, you know, looks can be deceiving. As many advantages as this has to actually getting your rates, I suspect, and I haven't even looked at the calculator yet for this particular loan, but once we plug in the same numbers, I suspect this one is going to, of course, be the highest one monthly. All right, so let's take a look at the calculator. We're looking at the rates for the Home Buyer's Choice Loan, and kind of like I was saying, without even having to have us look at it, look at the interest rate. 6.375%, APR as low as 6.693%. Down payment is, of course, 0. With this one, you don't put any money down. It's 100% finance loan. So I don't even need to do the 100,000. I could just put 0 for this one because there is no money down. So as you can see, and this is why it's very important to look at the figures. Yes, this is probably the easiest one for a first-time home buyer. No money down, no PMI, no MIP, seller contribution up to 6%. Easy, right? But look at your mortgage payment. It's the highest of them all. We saw as low as $2,200 if you put 20% down, of course, because you're putting down 20%. But the benefit of that is homes can be a hedge against inflation. The more money you put down, the more money you can make off of this property later on. That's going to be the thing that is going to offset that benefit of not having to put more upfront, is you're going to be paying more monthly. Taxes, insurance, and other costs are not included. Therefore, the actual payment obligation is going to be greater. So it's actually, all of our examples will be greater, but just know that it's going to be even greater than that. So that's why knowing your debt to income ratio and actually knowing, getting pre-approved is very important, because even if you are qualified for this loan, are you going to be able to afford $3,500, $3,600 for a mortgage? So that's the reason why it's really important, and why you want to understand the difference between all of these loans, and you want to understand what they come to, what you can afford, and why knowing your debt to income ratio is important, advantages and disadvantage of each one of these options. All right, let's move on to our last home loan when it comes to Navy Federal. Our last loan on the list is going to be the adjustable rate mortgage loan. Probably my least favorite, just because I don't feel like it's consistent. It's, again, adjustable rates. They call it an ARM as well. So Navy Federal offers a 5/5 ARM, which maintains a fixed interest rate for the first 5 years, and it adjusts every 5 years thereafter. Ideal for those who plan to move or refinance within a short period of time. So there's the advantage there. If you don't plan on keeping that property and maybe there's a really good rate that you could get at the time, this might make sense for you. They begin as fixed interest rates. They adjust up or down after the initial term, and the initial rate is generally lower and lasts for a set period of time. So ARM products contain two numbers. There's two numbers that you're going to see. The first refers to the number of years the interest rate will remain fixed. The second is the number of years between interest rate changes after the initial fixed term expires. For example, a 5/5 ARM would have the same interest rate for the first 5 years, and then the rate would adjust every 5 years after that. And ARMs, again, could be a good option for buyers who plan to stay in their home for a short period of time. No PMI. There's the no refi rate drop, and the refinance option is available. I really don't see many reasons why you would be looking at this particular one. It's a very unique scenario, and you'll have to be the one to make that call. But let's take a look at the calculator. Now we're looking at the adjustable rate mortgage loan. The interest rate is actually the same as the conventional loan at 5%, with APR as low as 5.666%. The down payment can be 0 or it could be 10%. So with the conventional loan, you can actually put down more if you had it. With this one, it's 10%, with term 10 to 30 year. So let's scroll down and take a look at the calculator. So I wanted to start by doing a 10% down payment. In this case, it would be $50,000 for $500,000. So at least for the first 5 years, you'd have an APR as low as 5.71%, and you'd have interest rates as low as 4.750%. Now, your monthly payment you're looking at is $2,347.41. Very competitive with what we already had. And let's check to see what would happen if we did 0 down. So $2,608.24 with APR as low as 5.714%, with interest rates as low as 4.750%. So for someone who may have been looking to sell this property, waiting for it to appreciate in value, and they could afford to have maybe a tenant that's going to pay $2,608.24 a month, maybe this makes sense. Maybe there was a reason for it. Again, every situation is different. There may have been a reason why this did make sense. But adjustable rate mortgages can provide attractive interest rates, but your payment, as we know, is not fixed. All right, I want to thank you guys so much for watching this video. I know that it was very, very long, but I did want to make sure that I provided you with as much information on these home loans as possible. I also wanted to make sure that I provided you with specific scenarios where each one can have an advantage, each one can have a disadvantage, and some of the requirements that are needed in order for you to get these loans. If you have any questions, please leave comments below. If you have one of these particular loans, please let me know. Which one are you using? Why? How does it benefit you? What are some of the advantages? What are some of the disadvantages? When you're looking to buy a home, are interest rates too high? Are you waiting? You know, these are all conversations that I would like to have. For me personally, I definitely am looking to buy some property. I am waiting for interest rates to go down, but as soon as the opportunity presents itself, I am jumping on it. I am definitely jumping on it. Definitely love rental property. It's a great hedge against inflation. It may not be for everyone. I actually have a video where I actually am talking about rental investing. So that might be something that you're interested in. Definitely let me know if that's something that you want more information on. But yeah, I think this is a really, really good look at how much you're paying, what you're getting, and hopefully you kind of understand how some of the lower, some of the first time home buyer, the ones that they're trying to present, you may want to maybe use it to first get into your home. And then you might want to look at a refinance option when you have more money to possibly put more money down. Or if your home and property increases in value, you can sell it. Hopefully you're able to make a profit for selling it, then use the money that you get for that home to be a down payment for your next home to hopefully reduce whatever it is that needs to be paid for the mortgage monthly. And maybe you could also get a lower term. There's different ways that you can kind of flip this and make money out of it and hopefully save money in the future on, all of your next property or even current property. So thank you again for watching this video. and you guys have a wonderful day.